Hi there, my name is Jason Ayers, CEO of the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our Portfolio Manager's Brief for November 2019. Well, we are now witnessing the longest U.S. economic expansion in history, despite there being no resolution to the trade war between U.S. and China. While trade-related weakness is restraining business investment and the manufacturing sector, this is more than being offset by a very resilient consumer-based economy. U.S. households are benefiting from lower interest rates, rising disposable income, and a positive wealth effect courtesy of the housing market. This all bodes well for household balance sheets and supports consumption spending, which, according to the Bureau of Economic Analysis, accounts for approximately 70% of U.S. GDP. And with the U.S. equity markets breaking out to all-time highs, investors continue to bet on accommodative fiscal and monetary policies to support further growth, at least into the 2020 elections. With the Canadian election behind us, focus now turns to whether a minority government can provide sufficient stimulus to continue to drive the economy forward. For now, GDP numbers look good. The job market is strong, driven by the services sector, and Canadians are benefiting from positive household balance sheets in line with their U.S. counterparts. Based on the recent economic data, the Bank of Canada decided to leave interest rates unchanged with the expectation that the economy should be able to stand on its own, for now. While the Canadian stock market has yet to break out to all-time highs, we have seen a positive uptick in November based on October's economic data. So, has our investment outlook changed? Whispers of a recession continue to get quieter as new global economic data points towards modest, albeit slow growth over the next couple of years. We may be back to that fear of missing out mentality that has been driving the markets higher all year. However, there is more and more data suggesting that stocks may have further room to run. And, as mentioned last month, we mustn't underestimate the impact accommodative central banks and low interest rates can have on offsetting macroeconomic concerns and subsequently supporting stock prices. That said, with markets at or close to all-time highs and investors becoming more complacent, the probability of a pullback is high, especially as we get closer to the end of the year. We continue to analyze companies on our watch list daily as the macroeconomic conditions change. These changes can influence the underlying corporate fundamentals significantly, and we are looking at selectively putting more cash to work on market pullbacks and as we uncover new opportunities while remaining defensive at these market highs.